Market up, market down, it doesn't matter. Here's a secret that smart investors use to buy their stocks: dollar cost averaging. Today, we're going to dive in. Now, a lot of people freak out or they stress out about when is the best time to buy stocks. And so they wonder, when the market goes up, do I buy? When the market goes down, do I buy? When it's in the middle, do I jump in? When do I jump in? Well, if you don't want to worry about that, you might want to consider doing dollar cost averaging. And what is it? So, dollar cost averaging is where you invest the same amount of money in the same amount of increments to invest in your stocks or your shares, right? So for instance, you may choose to invest $100 every month or $200 every month, right? And so what this means is it takes the guessing game out of when you're going to buy your stocks and to wonder what's happening in the market, because a lot of people don't want to deal with that, right? And so it's kind of like a set it and forget it, right? And so this is really one of the secrets that many investors use in order to beat the market. I'm reading the book, The Intelligent Investors, and this is one of the things the authors stress, right? And there are two benefits of dollar cost averaging. But before I tell you about these two benefits, I do want you to like, share, and subscribe if you are not already subscribed to this channel, so that you can get the videos when we drop them, or when I drop them every month. Every week, when I drop them every week, as well as I am on a mission to bridge the wealth gap, and that starts with you. And so I hope that this video is insightful, but I would love if you could share it with someone else who you think deserves wealth, because I think you deserve to be wealthy and everybody else deserves to be wealthy. Now, there are two benefits to dollar cost averaging, right? And so the first benefit of dollar cost averaging is it can potentially help you to reduce your cost per share in each of your stocks. So what does this mean? So when you buy stocks at a certain price, right, and you go in at another price, what happens is the market will take the average of those prices when you buy in increments, right? So for instance, let's say you buy stock A at $100, right? And then at another point in time, you go in and you buy stock A again, but it dropped to $50, okay? So what the market does, it takes the average of those two purchases, right? So $100 plus 50 divided by 2, $75. So now your average per share for those two stocks or two shares that you have is $75, as opposed to the initial purchase of $100. Now this is good because the lower your price per share is, the higher your margin for profit. And so for instance, if you get a share price or a price per share to average down to $75, I always say chances are, if a stock drops, chances are, depending on what's going on in the market, what's going on with the company, usually it will bounce back, and sometimes it bounces back higher. So if it dropped to 50, your average now is 75. When it passes that $75 mark and goes back to that $100, you now have a profit of $25 or more if it surpasses the initial price. But what dollar cost averaging does, it takes the guessing game out of trying to figure out when is the best time to enter. And so it's doing this, repeatedly, right? So if you're investing that $100 every month you're setting it to purchase shares every month, and it doesn't matter what the price is. So it's automatically doing this averaging down for you, right? And so that is really awesome. Another benefit is it helps to beat inflation. It does a pretty good job at beating inflation. And so, if you are very busy and you don't want to have to stress about what's happening in the market, when is the best time to enter, what to do next, this is really a good strategy that you should consider to use. And as matter of fact, a lot of smart investors build their wealth this way. And so I really do think that you should, in general, set it and forget it, where you're contributing at least some type of a payment out of your paycheck, whether it's $10, $20, $25, putting it somewhere to invest, whether it's in the stock market or not. But I do think you should put some money aside to invest. And if you can also do automatic transfers into your brokerage account. And so you can just set it up where it just purchases the share automatically, right? Because what you don't want to do is to have your money sitting somewhere, hopefully not in a savings account, a regular one at that. But if you have your money sitting around somewhere, or you get a lump sum, it's tax season at the time this video drops, right? And so you get this lump sum and you're like, let's go, I'm putting $2,000 in the stock market. That is not a good idea, my friend. So, because what happens is if you put $2,000 in the stock market and then it just plummets, your $2,000 plummets too. And yeah, that's it. While if you did dollar cost averaging, if you put $50 today, plummets. When it plummets, put $50 again. And then now you're averaging down, right? You're getting a lower cost per share. So you don't want to do a lump sum into the market all at once. So definitely consider dollar cost averaging into your play when you're doing investing. Until next time.